I'm Charlotte, I'm here to help you get through your CeMAP studies, and we are going to be talking about the interest coverage ratio. First, let me explain exactly why we have the interest coverage ratio. There's a really common misconception with buy-to-let property investment that as long as you have a 25% deposit, all that you need to happen is for your rental income to match your mortgage payments. And that's not the case, because if we did that, what we're not taking into consideration is things like insurance, property maintenance costs, and most importantly, tax. Remember, any income that you receive from a rental property is classed as earned income, and that means that you're either going to pay 20%, 40%, or potentially 45% tax on any income that you make from that. So the interest coverage ratio is there to make sure that it's a viable investment because you've factored in tax, insurance, maintenance, and all the other stuff. So let's work through an example. Let's use the calculation, and you're going to have to trust my maths here. So let's say you've seen a property in your area, it's going on the market for about £200,000, and you know that you can get about £700 a month rental income from it. You have the 25% deposit, so that means that the loan amount that you're looking for is £150,000. That is our starting point. So step one of the three-step method to this calculation is to take your loan amount, so £150,000, and times it by the interest rate that's being offered. I've picked an interest rate of 5.5%, that's roughly what's available on the market right now. So if we take £150,000 and times it by 5.5%, that's going to give us a figure of £8,250. Step two is to take that figure, which is how much interest we're going to pay over a 12-month period, and divide it by 12. And that's going to tell us exactly how much interest we're going to have to pay every month on the mortgage. We've taken £8,250, we've divided it by 12, and that's going to give us £687.50. That's our monthly interest payment. So we know now that our rental income is going to be £700 a month for that property, roughly, but we're going to be paying £687.50 a month just on the interest of the mortgage, which isn't where we want to be. Let's talk about step three. So the third and final step for this calculation is to factor in those extra costs. So tax, maintenance, and insurance, and anything else that comes along with it. That's where this comes in. Now, the lender is going to have to use a minimum figure of 125%, and I'll explain why in a second, but they can either use 125%, 145%, or even 160%. The choice is theirs. Some lenders will also just use a flat rate of about 145%. But why those figures? Let me explain. So if you are a basic rate taxpayer, you are going to pay 20% tax on your income. That's where that 125 comes in. If you are a higher rate taxpayer, you're going to pay 40% tax on your income, where they'd use the 145 calculation. And yeah, you guessed it, if you're an additional rate taxpayer, you're going to pay 45% tax on your income. And sometimes lenders will use that 165 times calculation to figure this next bit out. But for the purposes of the maths right now, we're going to use the 125 figure. So we're going to assume that you're a basic rate taxpayer. So we're going to take our 687 a month and we're going to times that by 125, which is going to give us a figure of £860 a month. That is the minimum income that the lender's going to expect to see if they are going to give us a mortgage for that £200,000 property. Now, we know from the start that we could only get about £700 a month from it, so it doesn't make it a viable option for us. This is a standard calculation. Every single lender will use it. They will just have their own percentage that they work with dependent on your circumstances. Hopefully that example will help. I'm going to recap the steps in another video, but don't forget to hit like, hit follow, and keep your eyes peeled for more help with your CeMAP studies.